formula that you get in section 11A. I will try and look at each individual component of that. So we'll look at each individual part of that. We'll break it down. We'll look at the different examples of each part of it, and we'll look at how to apply it in a scenario. And we'll play around with some different interpretations so that you can get a sense of what it is that you can expect and how you can handle any of those scenarios. We're going to look at the definitions, the reading of the definitions of gross income, and we're going to go into the general deduction formula. In the next workshop, we'll go into specific inclusions, exclusions, and the other parts of the general deductions where you have your specific exemptions. And then we'll go into capital gains in the workshop after that. Then we'll tie everything together, looking at questions, how to approach questions, how to structure your answers, how to reference case law in there, and how to bring everything together such that when you're dealing with a scenario, you're then able to handle any question that's thrown at you. So with everything else that I do, the way that I've always approached an exam, the way I've always approached a problem is I have to understand the basic principle. The understanding of the basic principle is very important, as that is the anchor point. From that point, you can branch out and start looking at different scenarios, looking at different problems, and applying that very same principle in dealing with that. In tax, you will always have these two opposing forces. You will have your receiver of revenue or the tax authority. Tax authorities always try to collect as much tax revenue as possible so that they can use it to better everybody's lives. On the other hand, you have the taxpayer always looking to pay as little tax as possible. And when you have these opposing forces, even you have a set of rules that's put in place in the Income Tax Act, there are always differences in opinions on how to interpret and how to read certain parts of the Tax Act and how to implement them such that you have consensus on how to deal with a specific scenario. And this is where you will have the definition becoming very important, because it's in understanding the definition that you then understand how to apply the definition and understand how you can conclude on any situation that you have. So that's the basis, and that's the basic starting point that I'd like us to focus on today. And I'd like you to, as I go along and you have any issues or you have any points that you feel you need more clarity on, please feel free to ask. So now that you have these two opposing forces, you've got the revenue authority that's put out all of these rules in the form of the Income Tax Act. You've got the taxpayer that needs to play within this set of rules. Now, as much as a definition can be clear and can be easy to understand, there'll always be situations that require somebody to come in and interpret the act or interpret the intention of the receiver such that then they can apply a certain part of the definition. And that is where you have your case law coming in. The case law has come in and it has helped us interpret some of these differences in opinions that may come about between what the receiver says is the intention of the Tax Act and between what the taxpayer believes the intention of the Tax Act. So together with your definitions, you should always, always, always remember that there's case law that comes with it. The case law helps you to interpret the definition, helps you to determine whether something needs to be applied a certain way or needs to be treated a different way. And in understanding that wherever you have these two forces coming together, your definition and you have your tax law or your case law, it gives you a great basis for then determining whether something should be treated a certain way or a different way. Now, for this level or at this level, there are certain concepts and parts of the definition that we're not going to go through in detail. Sorry, question. Okay, so I'm going to continue from there. So we're going to start with the first definition. We'll start with the objectives. So what's the objective of this workshop? But I'm hoping we'll get out of this at the end is you will work out of this with the ability to read and understand the definitions. Take a set of principles that you can apply when you're approaching any scenario with respect to the definitions based on what we've learned today. We're going to take into this the ability to apply case law to the definitions in any scenario that we have to then reach a conclusion on any scenario that you've got and then determine how to treat any transaction or any scenario that you've got. At the end of this series of workshops, my intention is to get to the point where we can sit together, look at a series of questions, and then answer them based on all the tools and the skills that you've learned through your course content, through your tutorials, and through these workshops, and work through a few scenarios and see how to approach this such that you can maximize the opportunity of passing any scenario that you put in place. So these are the objectives for today. The objectives will change as we go along, as we do tackle heavier content and heavier subjects, especially when we get into capital gains tax and all of the other parts that come with it. This will change, but as we go along, we'll have objectives, and I'm hoping we can always come back and look at it and tick and say, okay, are we happy? Do we understand how to read the definition and how to apply it? Do we understand how to bring in case law to bolster our argument whenever it is that we've got a scenario that is placed in front of us and that we need to deal with? And do we understand each and every single nuance that comes with it? So all those little bits and pieces of the definition that need interpretation or understanding. And if we were put in a scenario, would we be able to answer it? That's what I'm hoping we'll get out of this. So I'm going to start with the first definition, and that's the gross income definition, Section 1 of the Income Tax Act. Now, the gross income definition, there are a lot of components in there that require one to think and look at what it is that needs to be present for something to be included in gross income. And we'll deal with each component, and we'll look at it from two perspectives. We'll look at it from the perspective of an individual, me, you, everybody else. We'll look at it from the perspective of a company. And we will try and see where the two worlds merge and where the two worlds diverge. I'll be specific, and we'll look at how to interpret what it is that's relevant for a company and what it is that's relevant for an individual. So first part of it, of the gross income definition, says in the case of a resident. Now, what is a resident? How do you determine a resident? For this level, the assumption is that it will be given to you that you are dealing with a resident or not. But let's say you had to determine this at a very basic level. What is a resident? A resident is somebody that is off a place. So when it comes to individuals, case law in the past has gone into determining a resident as a person who belongs to a place that they will return to after their wanderings. And this is what case law has determined. What does that mean? It's a place that you feel a certain connection to, a place that you feel your ground, your roots, your life has been built on. That is where, as a natural person, you would reside as a person from a tax perspective. For a company, it's very easy. Where is the company incorporated? Is it a PTY LTD? Is it an LTD? Where is its place of effective management as well? So where is the decision making related to how this entity operates done? So if a company is registered as a company in South Africa, it is a resident of the company of South Africa. That is how you would determine what a resident is. For natural persons, is where you feel a sense of belonging. From your wanderings, if you go out and you travel overseas and you come back after 5 years, that is what you are, the place that you come back to, your home, the place where you feel you're belonging. That is where you are resident. Where if you're a company, it is where you're incorporated or where you have your place of effective management. Now, if you have a company that's incorporated in a foreign land, but all decision making is done in a branch within South Africa, you would have to start asking a question, well, where is the effective management of this company? And this is where case law comes in and starts looking into how do we then decipher this relationship and how do we determine where a resident is based. If you are incorporated somewhere, but your place of effective management is somewhere else, then there is this division that then case law helps to bring together. But that's for when you go further along in your studies. For now, incorporation, effective management, that's what you need to look at. Where is this company incorporated? Where is this company effectively managed? And that tells you where the company is resident. Once you have that, you go to your next step. Well, what am I dealing with? I need to have a total amount in cash or otherwise. Now, total amount in cash is easy to understand. If you're given an amount in cash, you know how much it is. The trick comes in the otherwise. What is meant by otherwise? Can somebody give me a thought or an idea of what could be meant by otherwise? If something is not received in cash, how do I know what to include in my gross income if it's not in cash? What could otherwise mean? Are there any thoughts?
Could be in loans or debentures.
It could be in different assets, that's correct. It could be in kind. So there's the concept of bartering, where I exchange one thing for something else, but nothing that we exchange is in the form of cash. So, for example, I am here and I am giving of my time to UNISA. UNISA could be paying me by saying, well, you can do a course for free. We don't pay you cash, but you can do a course for free at UNISA. That, the value of that course would become gross income for me because I've provided a service and I've received payment, but that payment is not in the form of cash. It's come in the form of something else. But that's something else, very important, that something else must have a monetary value. So just like if I am providing my services today, tomorrow UNISA says you can come and do a course for free, I'm not doing that course for free. I'm providing a service and they're paying me in the form of you don't have to pay for this course. The value of that course is what I would put in my gross income. Does that make sense? So the total amount in cash or otherwise, it's important to understand that cash is one form of receiving payment, but the other form could be either in an asset where I render my services, and like you said, they can give me debentures or another asset. The value of that asset becomes my gross income. If they give me a course, the value of that course becomes my gross income. So you do not have to look for a specific exchange of cash, but as long as there is an exchange of something that has a monetary value, this thing has to have a monetary value, then you know what to include. So now we know we've got a resident tech. Now I know something has to have a monetary value. Can be in cash, it can be in another asset, it can be in kind. But what's important is it does not necessarily have to be in cash for it to have a value. And for it to have a value, that's the only time you will put it into your gross income. If it doesn't have a value or that value cannot be determined, you can't include it in your gross income. But also very important is the concept of notional income. Notional income is something that you have foregone or you would have received had you done something. For example, if I had put 10,000 Rand of my money into a bank account, I could have earned 1,000 Rand of interest. That's notional. I haven't earned it. It's something I could have earned. But the Revenue Authority, SARS, cannot come and say, well, you had 10,000 Rand in cash. You could have put it in the bank account and earned 1,000 Rand. Therefore, you have to put that 1,000 Rand as income in your tax return. That is not how it works. Notional amounts are not included in your gross income. So cash or assets or in-kind receipts that have a monetary value form part of your cash or otherwise, but you specifically exclude any notional amounts. Do not include any notional amounts as those are not based on something that you have earned. It is something you could have earned, but it's not something that you would have earned. Received by, accrued to, or in favor of such resident. What does this speak to? This speaks to timing. And in terms of timing, you always recognize gross income at the earliest of receipt of accrual. If I have earned something today, somebody pays me tomorrow, I will recognize it today because I've earned it today. So if you're looking at two different periods, let's take, for example, a company. Company's year end starts on the 1st of January, ends at the end of December. If a company provides a service and earns the revenue this year, but only gets paid next year, February, it will only form part of their gross income this year because they've earned it this year. The receipt of cash does not follow the recognition in gross income. It is in the time that you earn, the earliest of earning it or receiving it in cash. If you've earned it this year and you receive it in cash next year, you recognize it this year because you've earned it this year. If you earn it this year and receive it this year in cash, it's easier, you recognize it this year in your gross income. So the timing is very important for you to understand. And it says during such year or period of assessment. So for a natural person, periods of assessment are standard. It starts at the end of February, so the 1st of March till the end of February next year. That's the tax period for a natural person. That's my year of assessment. When I'm doing my tax return, I look at all income and all my pension fund contributions from the 1st of March till the end of February. For companies, it's different. It's the company's financial year. So different companies that have different financial years have different years of assessment. And the tax period follows your financial year. So if your year starts from 1 January to 31 December, that is the year or period of assessment. If your year starts on the 1st of March, ends on 26th of February, that is the company's year of assessment. So always keep in mind that companies will have different years of assessments, and those years of assessments are based on their financial years. Very important to keep that in mind. And then it has a specific exclusion, and it says excluding receipts or accruals of a capital nature. This is a very difficult concept, but also a very simple concept once you get the hang of it. So when you think of capital items, you think of assets, you think of long-term investments or long-term assets. So a building is of a capital nature. But for tax purposes and for accounting purposes, depending on your trading, what you do for trading, a building can be a capital item for one person, but can be trading stock for somebody else. So it's always important to understand what it is that the person does for their trade that then determines whether something is of an income or is it of capital nature. So for me, if I buy a building, I intend to live in it. For me, it's a capital asset. There are people who buy and sell houses for a living. For them, that is income. When they buy a house, it's cost of sales, it's an expense for them. When they sell a house, it's income. It goes into their gross income. For me, when I buy a house, I capitalize it. It's a capital asset. It sits with me as a capital asset. When I sell it, I treat it as a disposal of a capital asset. Then I calculate capital gains tax on it. So it's very important to understand the nature of what it is that that person carries on as an activity or that company carries on as an activity that then determines whether something is of an income nature or a capital nature. If it's income in nature, it goes into your gross income. If it's capital in nature, it forms part of your capital gains calculation. Now, having said that, there are other things that case law has helped us to think about to help us understand whether something is of a capital nature or of an income nature. There's a principle that speaks to a tree and the fruit from a tree. When you think of that principle, the tree in this scenario is your capital asset. It's what produces what you get out of it being the fruit, and that fruit is the income that you've earned from this tree. So you've got that relationship of a tree and a fruit, and you've got the concept of what is your intention when you are buying this thing that you're buying. If I buy a house, my intention is to hold it for the long term. Therefore, for me, it's a capital asset. For somebody else, the intention is to buy the house, tomorrow sell it, make more money. For them, that's gross income. Now, just because I've bought a house today and I intend on sitting in it and living in it for years, doesn't mean my intention is not going to change. And the minute my intention changes, the nature of the asset changes, and it stops being income or capital and changes and becomes the other thing. Apologies for that. So determining whether something is an income or capital nature, you look at the intent and you look at whether this asset has been bought for long-term holding and disposal, or is bought as part of your trading activity, in which case it forms part of your gross income. Now, the other part about a year of assessment that's also very important and to keep in mind, in some cases, they may throw a scenario at you where you tick all the boxes. This is a resident, this is cash, or it's something in kind, it's been received, and it doesn't fall into this year of assessment. The moment you have one of these items not being true, so this person is not a resident, okay, we need to start looking at the rules that apply to non-residents. For your level, you assume it's a resident if it's given to you as a resident, and if you're told it's not a resident, then you don't have to worry about going through this process. Is it cash or otherwise? So you go through that thinking. What have I received? Does it have a monetary value? Can I determine what that monetary value is? Okay, great, tick. Have I received it, or is this something that I've received on behalf of somebody else? If somebody today comes to me and gives me 100,000 Rand, and this 100,000 Rand belongs to somebody else, I'm not going to include it in my gross income because it's not in my favor. It's not for me. I'm receiving this on behalf of somebody else. So I take that 100,000. The person who receives it is the person that recognizes it as their gross income. So always consider those scenarios where you could be receiving money on behalf of somebody else or on behalf of another company. Just because it's received, it's cash, you're a resident, and it happened in the year of assessment. If it's not in your favor, you do not include it in your gross income. It belongs in the gross income of the person who has unconditional entitlement to that cash or to that benefit, whatever it is. So there'll always be, or in many scenarios, you'll find yourself ticking all the boxes, but not considering that, hey, maybe this is not in my favor, this is in somebody else's favor. Always consider, is this for me? Am I going to enjoy this benefit that's been received, or is this for somebody else? Once you've ticked all of these boxes, you've gone through, is it a resident? Can I say whether this is a total amount in cash or otherwise? Has it been received or accrued in the current financial year or in the current period of assessment? Is it in my favor? Then you can include it in your gross income. Are there any questions on that? Okay, so I'll move on to the next definition. And this is on the general deduction formula, section 11A, read together with section 23G. When you look at your framework, you've got your gross income, less your deductions, less or including your capital gains or losses. Then you've got your rebates. Then you've got your taxable income that you pay tax on. The general deduction formula, in terms of section 11A, speaks to a person may deduct from their income any expenditure from carrying on a trade. Now, carrying on a trade doesn't necessarily mean that you have a company that's registered that's buying or selling something. You could be offering services. Carrying on a trade doesn't mean that you have to have making a profit at the end of the year as your driving force for your trade. You could be carrying on a trade and you don't have a profit motive as the reason that you're carrying on this trade. That's the reason we have things as NGOs, non-profit organizations. Those are still carrying on a trade, but their intention or their motive is not to make a profit. So not having a profit motive does not take away from you carrying on a trade. Me being here right now, I am carrying on a trade. Now, once you've established whether you have a trade or not, everything else falls into place. But it's important to understand that for carrying on a trade, you don't need to have a profit motive as the reason for entering into that trade. And a trade doesn't have to take the form of a company. It doesn't have to take the form of manufacturing. It doesn't have to take the form of goods. It could be services, like I'm rendering a service now. This is me carrying on a trade. Then it goes on to you can deduct expenditure and losses actually incurred. In the gross income definition, there is amounts received or accrued. And what I said is you do not include, so actual cash, so it's cash or, sorry, if I go back to the gross income definition, it's cash or otherwise. And I said notional amounts are excluded. You do not include notional amounts. Same as with your expenditure definition. When you get to your expenditure definition, speaks to expenditure and losses actually incurred. Notional is also excluded. So just like you do not include notional income in your gross income, you do not exclude notional expenditure as part of your expenditure. Now, what's an example of notional expenditure? I have 10,000 Rand, same example as earlier. If I take the 10,000 Rand and I put it into a bank account, my notional income could be 1,000 Rand in interest that I'm earning. By putting it in a bank account, I could be incurring bank charges of 2,000 Rand. That extra 1,000 Rand in income doesn't go into my gross income, but I also don't get to deduct the 2,000 Rand in bank charges that I would be incurring. Those are notional amounts. Those are not amounts that I've actually incurred. So I cannot take notional amounts and deduct them from my gross income, just like I can't take notional income and include it into my gross income. So there's a concept of it has to be an unconditional. You have to be obligated to pay or obligated to offer the service or obligated to do something. It cannot be contingent. What is meant by contingent? A contingency is something that exists due to the occurrence or non-occurrence of something else. So for example, somebody comes and sues me and says, I taught them something wrong, they failed, they're going to sue me 10,000 Rand. That 10,000 Rand is not an expense on me because that has not been settled. I don't have to pay that 10,000 Rand until a court decides, actually, I owe you 10,000 Rand. This is all contingent. It's contingent on a court deciding whether I do owe you 10,000 Rand or I don't. So until something is unconditional, you do not deduct it as part of your general deductions. It has to be unconditional. Contingencies, you treat as contingent until it is unconditional and you do not get to deduct it. It has to be an amount that an expenditure or loss that you incurred in the production of income, in the carrying on of a trade. I am here, I'm doing this, I need a laptop. Now I've said I'm carrying on a trade by doing these workshops. So if I may ask, if I buy a laptop to be able to access Teams so that I can provide these workshops, can I deduct that from my gross income?
I think yes.
Why do you think yes? I mean, it's my laptop. I don't have a company.
But we are generating some income from it, is it not?
That's correct. I am. And I'm carrying on a trade. And it's directly linked to me earning this income. So there has to be a link between this expenditure and the income that I'm generating from this. Now, let me give you another example. As part of this, I buy a pair of Sony 7,000 Rand headphones. Can I deduct those as an expenditure?
No.
Why not? I need to speak to you and I need to hear you. So for me, I need the earphones.
Or is it, so that's linked to the
Well,
citizenship?
this is how you would go about then. If I can connect it to my income earning activity,
Mhm.
and I can show there's a direct link, then I should be able to deduct it. But if I'm using them
But
to play music when I work out and I jog, that's a different story.
I'm the one who raised a hand earlier. I was using
Oh,
a
sorry.
different gadget.
Okay.
Hear me. So I only wanted to know if there were notes already because I just saw definitions. But then soon after you shared the slides. So thank
Oh,
you.
okay. Sorry. Thank you very much for that. Sorry. I'm glad you managed to sort out your audio issues, and thank you for participating. I do appreciate it. So as long as you can put a reasonable argument that this is something that I am using in the production of income, and it's related to the trade that I am carrying on, then you can deduct it. Now, in the scenario that I gave earlier, I buy a pair of headphones or even the laptop. I buy my laptop, I use it. Oh, sorry. Who's Tini?
Okay, just a quick one. Are
Sure.
they not of a capital nature?
Well, it depends on how I use them. So I'm using them for this. I could treat them as of a capital nature if I'm going to hold on to them for long term and I'm going to, but headphones don't have that long of a lifespan. So you would typically expense them. But there is an argument that you can make that I'm buying these of a capital nature because I intend on holding them for a long term. And these are generally assets that last long term. You can do that. And what comes with that is for certain assets, you can write off every single year as part of your wear and tear a certain amount every year. So you could deal it either way. For me, I would treat it as an expense because it's related to this and I'm buying it specifically for this. So the headphones are linked specifically to my activities that I'm doing that are generating income. Therefore, for me, it would be an expense. But if you're going to treat them as a capital asset, you would have to do some serious arguing with SARS at the end, because if it's a capital asset linked to your activities, you'd have to do those activities for a long period of time and you'd have to be generating income. So yes, you could argue it. For me, I would argue it, yes, for me, it's an expense. But you could also argue that it's of a capital nature because for you, you're buying them for long-term use and therefore they are capital in nature for you. And that is the whole process. One thing can have two different implications for two different people. So like I said, a building doesn't have to be an asset. It can be trading stock for somebody else. So for you, Zwelithini, it's definitely capital in nature, and SARS would grant you that. If your argument is I'm holding it for long term and I'm going to use it as a capital asset. For me, I'm buying it to facilitate this course. I'm earning income, therefore I'm happy to expense it. So yes, you could argue that it's capital nature. Sorry, Paul?
Excuse me. I just wanted to know this trade, should it be a registered trade? I don't know if that is
It
stupid
doesn't
or
have
not.
to be a registered trade. Just like me facilitating this course, I'm not registered. I'm registered with UNISA, but I don't have a registered company. But I'm carrying on a trade. The laptop that I buy to facilitate this, SARS would allow me to expense it, and deduct it as part of my general deductions. So you don't have to have a company. It doesn't have to be registered. But as long as you're carrying on a trade, and it's a recognized trade, you can apply the general deduction formula or the general deduction definition. So it doesn't have to be registered.
Also, does it have to be a certain amount? Is there a cutoff
So
or starting point?
there is a point at which SARS says if it's an expenditure up to a certain amount, you do not have to treat it as capital nature. You can actually write it off in that year of assessment. There is a limit. If my memory serves, it's 10,000, but can I get back to you on that one? But
Okay.
there is an amount at which if you have an expense up to a certain amount, you don't have to treat it as a capital asset. You can expense it in that year of assessment. Okay. So important, if you do have a scenario where, just like I made earlier, I buy a laptop, I'm going to use it to facilitate this course, I can deduct the cost of this laptop as part of the general deductions in my year of assessment. Now, if it so happens that I also use this laptop to do work or to do something else that's unrelated to my trade, so if I play games with it, or I use it for general household purposes, I do my household budget, I'm allowed to deduct the expenditure to the proportion that I use that laptop for carrying on a trade. So if I spend 10,000 Rand on this laptop, but I use it 50% to facilitate this course, I can only claim 50% as a deduction for tax purposes. The other 50% is not for carrying on a trade, it's a personal expense. I cannot claim it as a deduction. Does that make sense? So you do not have to have either or, where you either include all of it or you include none of it. There are scenarios where you can include part of your expenditure as a general deduction and part of it will not be allowed. So for as long as I'm incurring expenditure that is not in carrying on a trade and is not linked to the production of income or the generation of income, I cannot claim that as a deduction.
Okay, so I'm having a question.
Sure.
How do you then calculate that percentage? Is it per time spent?
It depends. So for example, if I live in let's say a 2,000 square meter house. So let's start with the simplest one. If I've got a laptop, I use it 50% of the time for facilitating this course, 50% for something else. You use time spent. In the scenario where I have a house and I pay a bond on my house, I've taken a bond and I pay, let's say, 20,000 Rand in my bond every month. Within my house is an office. So I'm using that office space exclusively for carrying on a trade. And that office space accounts for 10% of the total square meterage of the house. SARS will allow me to deduct the interest on my bond, not the full bond, the interest on my bond to the extent that I'm using it to carry on a trade. So the 10% that I'm using to carry on a trade, I can deduct as a deduction for tax purposes. So I'll take my interest, calculate 10% of it. That amount I can deduct for tax purposes. The other 90% does not relate to me carrying on a trade. I use the house for other purposes. Therefore, I can't deduct it. So it's not necessarily just time spent. It's the proportion of that asset that you use or of that expenditure that relates to the production of income. So it could be anything. It could be percentage of space usage. It could be time used. It could be anything, just as long as you can quantify it and there is a reasonable way for SARS to be able to use that same quantification. Because if SARS can't quantify the percentage of my house that I'm using to carry on this trade, I will not be allowed to deduct it. So I have to be able to show them the plans for my house look like this. This portion of the house is the office. That portion I use exclusively for carrying on a trade. Therefore, the interest on the bond, I am going to deduct that portion of it only as part of my tax return.
I got that. Thank you.
So in terms of what the objective that I had set for today, I had said our objective is at the end of the day, can we read the definition? Can we understand the definition? Can we use the definition in different scenarios presented? And there's this third piece that I haven't touched on that I'd like to touch on now. And we'll go through it in as much detail as you'd like to go through. But I do know from case law, the expectation is you can apply the case law to specific arguments that you're making based on the definitions. You don't need to know the detail of the different cases. As you go on and you start getting into the detail of the different cases, there are different scenarios that are presented there. Some are very interesting. Some are very sad when you read them. But this is the nature of what it is that you are studying or what it is that you are learning, is all of these different scenarios that can present themselves. How do you handle them? And case law, in the case where there is a dispute or a disagreement, or there is no clear um, interpretation of something, helps us find a way to interpret it. And there isn't necessarily one case law that deals with, for example, whether somebody is a resident or not. There are different cases that have dealt with that because there have been multiple scenarios and different situations where the courts have had to come in and decide whether somebody is a resident or not. So you will have a long list of case law. There'll be different scenarios that are presented there, and there are different outcomes. But within those outcomes, we get pearls of wisdom that help us understand how do we then apply a certain ruling from a case in determining whether a certain scenario applies or not. Now, can somebody tell me, from the case law that you've engaged with, is everybody comfortable with how to interpret the case law and how to apply the case law when you're answering a question for tax purposes? Is everybody comfortable with, I know what case to apply for any other part of this definition? So if I want to prove somebody is a resident, I can apply this case to the definition of a resident. And in this case, the courts had to deal with this question, and this was the outcome. And therefore, this is how it applies to the scenario. And therefore, this is a person who is a resident or not. Is that something that everybody's comfortable with, or is that something that you would like me to go through and to help you build up, looking specifically at the gross income definition? I won't go into all of the cases, but I'll go into how do you then bring in case law when you're looking at a question, how do you apply it? And then how do you come to a conclusion, and how do you describe that conclusion? Or maybe I can leave that for the last part when we go through how do we deal with questions and answers. So should I go through case law now, or should we have a whole separate session on case law and look at how to apply case law and how to answer questions when it comes to case law?
Personally, I think the lesson on that would help instead of just passing through. I've always feared, I love, but when it comes to citing and everything, I feel like I'm being turned into a lawyer or a lawyer.
And it's a very valid fear, Mpo, and I appreciate you for saying that. It's a very valid fear because some of these cases, when you read them and you go through them, I remember in my third year of varsity, because we started doing tax in third year. So when you start with Income Tax Act, you start with case law, and you are expected to not only know each individual part of the law off by heart, because we're not allowed to actually even carry in our books into exams, but you're expected to know which case relates to which part of every single definition. You're expected to cite all the details of the case, and then you're expected to apply that case law to a scenario and reach a conclusion. So I understand that fear. I've lived through that fear. I overcame that fear. So I'm hoping to help you get to that point to overcome that fear as well. So we will have a separate session on case law.
And the way you quoted the structure.
Happy to go through that as well. I mean, what is important when it comes to case law is being able to apply the right case to the right scenario. The one thing that can trip us up at points in times is when you apply the wrong case to the right scenario, and then you end up with the wrong conclusion. So it's very important to understand when to apply case law, how to apply case law, and how to come to a conclusion based on the case law. So I think, as you suggested, Mpo, we'll leave that for a later session, and we'll also incorporate that for a session when we go through how do you approach a question in tax. If you're given a scenario, how do you structure your answer? How do you bring in all the different elements, your definitions, your case law, application of case law, and getting to a conclusion, and then making a determination at the end. So I'll take that guidance. So let's do a brief recap, go through parts that we've gone through, play around with a few scenarios, and I'm hoping that we can get to the point where then you can share with me any areas of concern that you have, any areas of help that you need, and let's see if we can get through that in the next 45 minutes. So we've gone through the gross income definition. Gross income definition says in the case of a resident, including their gross income, the total amount in cash or otherwise received by or accrued in favor of a resident during such year or period of assessment, excluding receipts or accruals of a capital nature. There's a linkage between that and what you have in your general deduction formula, in that there's this constant theme of you do not include receipts or expenditure of a capital nature. And all of this will become clearer when we start incorporating capital gains tax into this, where you start seeing the question that I asked earlier around the headphones. And I don't recall the gentleman who answered, and he said, or he asked, is this not of a capital nature? Very right. It could be of a capital nature, but there's a special or a specific part of the Income Tax Act that says if you have expenditure up to a certain amount, you can deduct all of that expenditure in that year of assessment. So there's also that part. So expenditure can be of a capital nature, but if it falls below that threshold, you can deduct it all in that year of assessment and you don't carry it forward as expenditure of a capital nature. So there are those provisos that we'll go through as we go forward in time. Now, whether that is part of the cost content for this year, I will confirm and make sure that I do not include elements of cost content that will be covered later on. But for information purposes, we can include that. So remember the parts that you need to be able to put down and be able to explain and be able to give yourself comfort that you've covered. If you've covered that, one, this person I'm dealing with is a resident. Either they're a natural person who is a resident of a country, or they are a company that is incorporated or has its place of effective management within this country. Then they're a resident. For your purposes, you will be told whether a person is a resident or not. But you would go through that process of then determining, is this person a resident or not? Once you've determined it, that's the first tick. Come to the second tick. In this scenario, is there an amount that's in cash or otherwise that I can see? Or do I need to determine it? And if I can determine it, does this thing have monetary value? We'll go back to the example I gave earlier. I am a resident. I am providing a service now. If UNISA comes to me and says, instead of paying you whatever we were going to pay you in cash, we can take a course with us for free. That for me falls into that part of otherwise. So in my gross income, I would include the value of the course that I am receiving from UNISA as my gross income. That course is a monetary value. I can go on the website, or I can get a brochure that says, for this course that you're getting for free, you would have paid X amount of money. That X amount of money, I would put it into my gross income because I've provided a service and I have been paid in a form other than cash. So remember that it does not have to be a payment that's received in cash. It can be received in the form of an asset, or it can be received in kind. In kind means in an exchange or in barter. So it doesn't have to be something that's tangible. It can be something that's intangible. It can be me attending a course. I don't have something physical to show. I don't have cash. I don't have an asset, but I have something that's intangible that has value to it. It has monetary value to it. Always very important to remember that. Received or accrued or in favor of, unconditional entitlement to this receipt. So if somebody pays me money that I meant to pass on to Mpo, this is not for my gross income. I may have received it, but it's not for me. I'm not unconditionally entitled to this. This belongs to Mpo, therefore I have to pass it on to Mpo. I'm sorry I'm using your name, but that is what I would have to then do. The person who has unconditional entitlement to this would include it in their gross income. Therefore, I don't go and put it in my gross income, then Mpo puts it in their gross income. Then there's two people that are sitting with gross income of 100,000 Rand related to the same amount. And it has to be recognized at the earliest of accrual or receipt. The concept of accrual speaks to when have you earned it, not necessarily when have you received it. So if I've earned it today, it accrues to me today. If it's paid to me in 3 years' time, I've earned it today, it must go into my gross income today. Very important. The timing is important to understand when you include it into your gross income definition. And by the way, if I may ask, why is it important to then include something this year if I've earned it when I can include it next year when I receive it in cash? Why would that be an important concept or an important principle to enforce or to always remember? Any thoughts?
Because, sorry.
Promise?
It's a matching principle. We are matching current income with the expenses of that particular year.
Yes, that's part one. Any other thoughts on why it would also be important? Mpo, what was your thought? Or did you have the same thought as Promise, Mpo?
I just thought maybe it could be that when you delay it, there are some other expenses related to that. I don't know.
So if you think about it, SARS.
Some form of,
Yes,
yeah.
continue, sorry.
Yes, I was just saying maybe there is some form of punishment towards delaying.
Not necessarily.
Delay.
So if I was to put something in my gross income this year and I put it in next year, I'm going to pay tax on it this year or I pay tax on it next year. There's another part to it that has to do with regularly SARS reviews how much tax people pay. So for companies 3-4 years ago, the tax rate was 28%, or was it 5 years ago? And the tax rate was cut to 27% after that. Now, if I had included an amount this year when my tax rate is 28%, I would have paid SARS 28% of the amount I received. If the tax rate changes and I put it next year, I'm paying less tax on it. So for SARS, it's very important to include income in the year it is earned, because if there's a change, there's a potential loss for them and a potential benefit for you as a taxpayer. But it can also work the other way around. So it doesn't always work against SARS. It could be a situation where SARS says we're adjusting tax rates, we're increasing the rate of tax. Now imagine if you've earned something this year, the rate of tax is 27%. You receive the cash next year. If you include it in your tax return next year, you're going to pay 28% versus including it this year where you pay 27%. So having clarity as to which year of assessment it belongs in can have an impact as to how much tax you pay. Does that make sense? Promise, I see your hand is still up. Do you have a question or?
Oh, sorry, I was trying to put it down, but I'm failing.
Okay, it's fine. So important, does that make sense? This year I could be penalized because tax rate is 28%. I included in my income this year, I pay 28%. Next year, tax rate could be 27%. It might be of benefit for me not to include it in my gross income this year, but include it next year and pay less tax. SARS wants certainty. They want to know that you've included it in the year that you have earned it, so that you pay the right amount of tax. So annually, SARS will review tax tables. They'll review personal income tax. They'll review the marginal rate of tax that people pay. Depending on where that sits, recognizing something as your gross income in one year versus the next can have an impact on how much tax you pay. So having clarity as to when it sits can determine how much tax you pay. And for SARS, it's clear it's the earlier of receipt or accrual. If you've earned it, you include it in your gross income. And year of assessment, as I've mentioned, for a natural person, our years of assessment are clear. Starts at the 1st of March, ends at the end of February. For companies, it's their financial year. Yes, Paul?
Yes, what if it accrues but it never comes through?
Then there are provisions for writing off bad debts later on. So SARS has included provisions for saying, I have included this in my gross income, but now I haven't received it. There's a provision that relates to bed dates where you can then get a deduction for that at the point where you've determined that you are not going to receive it. So it will fall in 2 tax years, yes, but that is the way that it works, yes, unfortunately. So you could have, I've included it at this rate this year, but I'm getting a bad debt deduction in another year where the tax rate is different. And there are also restrictions on how much you can write off. There's that principle, but we'll get to that. Does that make sense?
Yes, it does.
Yes. So you'll include it this year. If in 2 years' time you don't receive the money, there are provisions that allow you to deduct bad debts. You will deduct it at that point, and then you'll follow those provisions. Okay. So as I mentioned, year of assessment, natural persons, 1st of March, end of February. For companies, it's the financial year. So different companies can have different years of assessments based on their financial years. And there's always the annual budget speech where the Minister of Finance stands and makes pronouncements. And depending on which point of your financial year that budget speech happens, can have a significant impact on your tax affairs for any period of assessment. So for the company I work for, our year of assessment is 1st of January till the end of December. When the Minister of Finance stands in February and makes all the pronouncements that he makes and makes all the changes that he makes to the Income Tax Act, and he says these are effective as at the 1st of March. Now you can imagine we're sitting in a situation where for 2 months we're applying a certain set of rules. For the next 10 months, we're applying another set of rules. And it's always making sure that you balance that exercise of ensuring that you're applying the right set of rules for the right period of time. It won't always be that the Minister of Finance makes pronouncements that match up with your year of assessment. So you might have a situation where you're applying 2 sets of principles for the same financial year, but that has to do with when things kick in and when things are effective from a tax perspective based on your financial year. But for now, assumption, your financial year is your year of assessment. Things will happen within that period. You will treat them as such. So that's the gross income definition. Then we get to the general deduction formula. General deduction formula, very important to remember, carrying on a trade does not necessarily have to be a registered company. You could be carrying on a trade as an individual. And carrying on a trade does not require you to have profit as the motive for carrying on this trade. Therefore, you do not have to go and say, my aim is to make 50,000 Rand profit as this company or as this person for you to be carrying on a trade. NGOs, NPOs are carrying on a trade. So profit motive is not a necessity. Expenditure and losses have to be actually incurred. The concept of unconditional versus contingent. And remember, contingent is something that will exist or something whose existence will be defined or will exist based on the existence of something else. So for me, for example, that I always use, the example that sticks to mind, the example that we always deal with. For me, as an insurance company, you will have somebody who will come and will put in a big claim. Being an insurance company, somebody can come in and say, I've got cancer. And I've got cancer and I have a policy, you have to pay out 20 million Rand. As an insurance company, we can look at this and go, well, and I should be very careful. Let me not use my employer as an example. Let me use a very different example altogether. You could be sitting there as somebody who works for a company. Somebody comes in and says, look, I have a claim against your company for wrongful termination. You fired me, you didn't have cause to fire me, so I am going to sue you for 20 million Rand. For as long as there are legal proceedings, until there is finality and certainty, and you have to pay this person whatever amount the courts say you have to pay them, that amount is contingent. That expenditure is based on a ruling from the courts that say you have to pay this much. Therefore, for as long as you do not have that ruling, you do not have an expenditure that you can deduct. Until there is certainty and until it is an unconditional expense or loss on your part, you cannot recognize that. Okay? And it has to be linked to the production of income. As I said earlier, I've got a laptop. If I buy my laptop, if I use my laptop 50% for this, 50% for something else, only the portion that I'm using in the production of income can I claim as a deduction. Even if it falls below the 10,000 Rand threshold, only the portion that I can say relates to the production of income can I claim as a deduction. Anything else, I cannot claim as a deduction. And it cannot be expenditure of a capital nature. Expenditure of a capital nature, depending if it meets certain criteria, will form part of your base cost. And you will do that, and we'll look at that when we get to capital gains tax. So those two principles are very important. If you understand your definition, you understand all the little bits and pieces that can complicate the implementation or you being able to apply it. For example, something being contingent or something being of mixed use. Mixed use meaning part of it is used to the production of income, part of it is not. For you being able to then say, as long as I've got an expenditure that I've incurred from carrying on a trade, and it is that trade, that expenditure is linked to the production of income, then I can deduct it. If it's half of the expenditure, then you can deduct half of the expenditure. But you have to be able to link that expenditure to the carrying on of a trade and to the production of income. If you cannot do that, then you cannot deduct it. Okay. So different scenarios require different applications and different interpretations. But for as long as you've got your principles, for as long as you understand how to apply those principles, there shouldn't be anything that can trip you up when it comes to applying these definitions. So are there any questions in terms of what we've gone through today, what I've explained, parts of the definition? Are there any parts that you need me to spend a little bit more time on or give a little bit more context on? Or is everything making sense? Can everybody
So
still
you're
hear
saying,
me? Sorry. Yes, go ahead.
okay, so you're saying contingent is a case that is not proven yet.
So it's something
It's
that
not.
is the existence of it will only be confirmed by the occurrence or non-occurrence of something. So for as long as there is that doubt,
Okay.
it's contingent. So for as long as that there's a possibility that you will not have to do something, then it's contingent. So like a lawsuit, for as long as there's a possibility that I won't have to pay this person that's suing me, it's contingent. Until there's finality and there's clarity on this issue, it's contingent.
Could you kindly explain again as to why is it important to record the amount on the current year and not on the next year?
So this is my view of it, but this is how I believe SARS views it. In every year, SARS will review multiple things. So for one, there's a VAT rate. Two, there's the income tax rate. Three, there's also that part of for personal tax, they will review the tax tables. So there needs to be clarity as to in which year of assessment income falls or an expense can be deducted, because depending on that year of assessment, the amount of tax that you have to pay will become determinable. So if I have income of 100,000, if the marginal tax rate that I have to pay this year is 45%, I know I have to pay 45% of 100,000 as tax. Next year, SARS might pronounce that marginal tax rate is 40%. Now I only have to pay 40%. So when I started, I said there is these two worlds that we're operating in. SARS wants to collect as much money as they can. As a taxpayer, taxpayers always trying to pay as less tax as they possibly can. So you'll find yourself in the situation where I'm looking for the best possible outcome for myself. So I will include income in the year where I pay the least amount of tax. For SARS, that's not beneficial. So SARS needs people to understand that you will pay tax in the year in which you accrue or in which you have earned this income. So you do not do this switching and choosing which year of assessment benefits you, and therefore you pay the least amount of tax. So it's to ensure that all taxpayers are treated fairly and equally, and it's to ensure that you pay tax in the year of assessment in which it relates, and therefore you pay the amount of tax that you need to pay. If I can choose which year of assessment I pay, whether I pay in the year I accrue or the year that I receive cash, I as a person would always pick the year of assessment where I would pay the least amount of tax. But for SARS, that doesn't benefit them. It doesn't work that way, and it shouldn't work that way. If I've earned 100,000 from doing this, somebody else has earned 100,000 Rand from doing the very same thing. If we are in the same tax brackets, we should pay the same amount of tax. There shouldn't be a situation where somebody pays more tax and the next person pays less tax simply because we've chosen to apply different tax rules. The rules are the rules and we need to apply them the same way. So SARS wants to ensure that we all understand when it is that we need to pay tax, and we don't have a situation where people choose the year in which it benefits them the most to pay the least amount of tax. So every year, the Minister of Finance will stand in front of Parliament and will say, we're going to cut taxes for individuals by this much, meaning that for that year of assessment, you will pay less tax. So if I include the amount in my gross income in the year of assessment where they've cut taxes, I'm going to pay less tax. So I will choose to do it that way. But the law is the law. As much as I would like to have it that way, I will have to put amounts in my gross income in the year in which I've earned them. So it's to ensure that there is consistency, there's fairness, and that there's clarity as to when income was earned and how much tax needs to be paid. If you can choose whether to pay it in 1 year or to pay it in the year in which you receive it in cash, I can assure you people would wait for 10 years for tax rates to be cut to then receive the amount in cash and then put it in their gross income in that year. So the most important reason for SARS is let's have equality, let's have fairness, let's have consistency, and let's make sure people pay the right amount of tax. If you can choose when you pay tax, I'm sure you would do the same thing. If you could choose the year in which you would pay tax, you would choose the year in which you pay the least amount of tax. That's how we would do it. That's how I would do it. But for SARS, they need to know if you've earned this amount of money, if I've given this workshop today, if UNISA pays me in 3 years' time, and tax rates are lower in 3 years' time, I've earned it today. I need to include it in my gross income today, and I need to pay my tax in this year of assessment based on the prevailing tax rates. So for SARS, it's important to have that principle locked in and understood so people understand that you pay tax consistently, it's the same for everyone, and you do not have a situation where people can afford to delay when they pay tax and then benefit from paying lower taxes later on, whereas others cannot have that benefit and therefore have to pay a high amount of tax. Okay, so all of those principles put together will include case law. We'll build on this as we go along. Next week, we'll start looking at other concepts, your inclusions, your exclusions, and then we'll build this picture and we'll start building out that framework. And as we go along, I'll try and bring in real life examples. I will not use my employer, but I'll bring in real life examples and we can debate and we can have discussions around them. Because the more you practice these things, the more you talk about these concepts, the more you work through scenarios, the better your understanding of things become, and the better the greater your confidence grows in dealing with these things. So from my part, understanding of principles is important. Interpreting the definition, being able to apply each and every part of that definition, linking it to case law, being able to take case law and apply it to the scenario and being able to reach a conclusion is what gets you to the point where you can pass any exam that's put in front of you. And as I said, as much as I can throw any scenario, you've handled them very well. Every scenario I've put out there to say, if I buy a laptop, if I buy headphones, if I use it for this, how do I determine this? All of those are scenarios that you will most likely come across. That question around how do I determine the proportion? Is it time spent? Is it percentage of area used? Those are scenarios that you will highly likely come across. I know in my exams, I know in my board exams, I came across certain scenarios that had to do with somebody is using an office space of this much for running a business. And now how much of that can they deduct? And there are certain specific other parts of it, like the example I gave earlier about you pay a bond. The bond itself is not what you can deduct, but it's the proportion of interest on the bond that you can deduct. But those are the very deep parts of the tax law that we'll get into as you go forward in your journey on tax. But what's important is to understand that the principle still stands. If I've incurred an expense in the carrying on of a trade and it's related to income, I can get a deduction for it. I can throw any scenario at you. That principle, as long as you've got it, you can apply it and you understand how to structure your responses in applying it, you will be fine. So I've spoken for an hour and a half.
Thank you.
Do you have any questions? Is there anything else that you would like me to clarify, to go over, to give more emphasis on? Are there any questions that you have? And one more, I really do appreciate the interaction. It was great. Going forward, please feel free to, at any point in time, stop, ask questions. Really appreciate them. Very insightful. And I enjoyed the session. So I'm hoping to see you at the next session.